What if the headlines are only telling you half the story? We're constantly bombarded with predictions of booms and busts, but what lies beneath the surface of these pronouncements? The economy isn't a straight line, it's a series of swells and dips, a rhythmic dance of expansion and contraction. Understanding these cycles, these predictable ebbs and flows, is more than just predicting the next recession. It's about shaping a long-term strategy, a strategy that can weather any storm and capitalize on every opportunity. Sustainable wealth creation isn't about timing the market perfectly. It's about understanding the market's inherent rhythms. It's about building a portfolio that isn't just reactive but proactive, designed to thrive in different economic seasons. We're not just chasing fleeting gains, we're laying the foundation for lasting prosperity, a legacy built on knowledge and foresight. Benjamin Graham, the father of value investing, wisely said, "The investor's chief problem, and even his worst enemy, is likely to be himself." How often do our emotions, our fears, and our greed cloud our judgment and lead us down the wrong path? Economic cycles can feel like emotional roller coasters, but understanding them provides a framework, a grounding force that helps us resist impulsive decisions. By recognizing the patterns, we can detach ourselves from the emotional frenzy and make choices based on logic and data, not fear and speculation. Think of the economic cycle as the breath of the market. There's an inhale, a period of growth and expansion, and an exhale, a period of contraction and consolidation. To thrive, we must learn to breathe with the market, anticipating the shifts and adjusting our sails accordingly. What if your long-term strategy could be shaped not by fear, but by a deep understanding of these fundamental rhythms? What if you could transform market volatility into your greatest advantage? Have you ever heard the phrase, "This time is different"? It's a seductive whisper, a siren song that lulls investors into a false sense of security. But in the world of economics, permanence is an illusion. Our minds are wired to see patterns, but also to believe that our asterisk present is somehow unique, exempt from the rules of history. This recency bias, this confirmation bias, can be incredibly dangerous. Think back to the dot-com bubble, the housing boom of the mid-2000s. The narrative was always the same. This is a new paradigm. The old rules don't apply, and what followed? Significant market corrections, devastating losses for those who bought into the hype. The truth is, economic cycles are as old as markets themselves. They're driven by fundamental forces: interest rates, inflation, innovation. Data consistently shows that markets tend to revert to the mean, regardless of the prevailing narrative. So, how do we protect ourselves from this illusion of permanence? Develop a cycle-aware checklist. Evaluate investment opportunities based on valuation multiples, debt levels, and industry growth rates, always adjusted for the current phase of the cycle. Are valuations stretched? Are debt levels unsustainable? Are growth rates realistic? Warren Buffett, a man who has witnessed countless market cycles, once said, "The seasons return, and today I'm 55. Economic cycles are like seasons. Periods of growth are inevitably followed by periods of contraction." The key to long-term strategic success lies in adapting to these changes, not denying their existence. Don't let the illusion of permanence cloud your judgment. Embrace the cyclical nature of the market, and you'll be far better prepared for whatever the future holds. Have you ever considered the unseen forces shaping the markets? The subtle hand that guides the ebb and flow of the economic tide. It's often invisible, yet its power is undeniable. Interest rates. Central banks wield this lever to either stimulate or cool down the economy, and their actions have profound consequences for every asset class. Historically, changes in interest rates have had a quantifiable impact on stocks, bonds, and real estate. When rates fall, borrowing becomes cheaper, companies invest, and asset prices tend to rise. Conversely, when rates rise, borrowing becomes more expensive, growth slows, and asset prices can decline, but it's not instantaneous. There's a lag effect, typically 6 to 18 months, between an interest rate adjustment and its full impact on the real economy. This lag creates opportunities for astute investors who can anticipate these effects, who can see the ripples before they become waves. Inflation plays a crucial role. Rising inflation often compels central banks to raise interest rates to cool down the economy, which in turn can dampen growth. So, how do we become more attuned to these economic rhythms? Monitor key economic indicators: the Consumer Price Index (CPI), the Producer Price Index (PPI), and GDP growth. These data points offer clues about future interest rate movements. Develop a proactive portfolio allocation strategy, shifting towards defensive assets during periods of rising interest rates and positioning yourself to capitalize when rates eventually fall. Interest rates are like the thermostat of the economy. Adjust them too aggressively, and you risk overheating, leading to inflation or freezing the system, triggering a recession. Understanding this delicate balance, this unseen lever, is crucial for navigating the complexities of the market cycle and shaping a long-term, resilient wealth strategy. Debt is a double-edged sword, a tool that can amplify both gains and losses. During economic expansions, readily available credit fuels growth. Companies borrow to expand, consumers borrow to spend, and asset prices inflate, creating a sense of prosperity. But this debt-fueled growth can be unsustainable, leading to asset bubbles that eventually burst. The subsequent deleveraging process, the painful unwinding of excessive debt, can be devastating. Asset prices plummet, businesses struggle to repay their loans, and economic hardship ensues. Consider the impact of corporate and consumer debt levels on economic stability. Key ratios like debt to equity and debt to disposable income can provide early warning signs of potential trouble. So, how do we navigate this treacherous terrain? Develop a framework for evaluating the debt levels of individual companies and entire industries. During economic expansions, prioritize investments in companies with strong balance sheets and low debt levels, companies that can weather a downturn. Conversely, during economic contractions, avoid companies burdened with excessive debt, companies vulnerable to bankruptcy. Imagine the economy as a tightrope walker. A little debt, a little leverage can help them reach greater heights, allowing them to take bolder steps. But too much debt, too much weight, and the fall is inevitable. Understanding the dynamics of debt, its seductive allure, and its potential for destruction is crucial for building a resilient portfolio and safeguarding your long-term wealth. Be mindful of the tightrope and walk with caution. Innovation is the engine of economic growth, but it's also a force of disruption. Joseph Schumpeter called it creative destruction, a process where new technologies emerge, rendering old industries and business models obsolete. Think of the automobile replacing the horse-drawn carriage, or the internet transforming communication and commerce. Identifying these emerging technological trends early on is crucial for capitalizing on the growth potential of innovative companies. But beware the hype cycle. Initial excitement about a new technology often leads to unrealistic expectations, followed by disillusionment when those expectations aren't immediately met. Consider the rise and fall, and eventual rise again, of the internet. The initial hype fueled the dot-com bubble, which burst spectacularly. But the internet's long-term potential was undeniable, and it eventually transformed the global economy. The key was identifying the underlying value despite the short-term volatility. So, how do we navigate this innovation cycle? Develop a framework for evaluating the long-term potential of emerging technologies. Focus on technologies that solve real problems, that create significant economic value. Diversify your investments across multiple technological trends to mitigate risk. Not every innovation will succeed, but those that do can generate substantial returns. Ride the waves of technological disruption, but do so with caution and foresight. Understand the hype cycle, identify the true innovators, and diversify your portfolio to capture the long-term benefits of technological progress. Don't be blinded by the initial excitement, and don't be discouraged by the inevitable setbacks. Focus on the enduring potential, and you'll be well positioned to thrive in the age of innovation. What if your biggest obstacle to successful investing isn't a lack of knowledge, but a flaw in your own thinking? Behavioral biases, those ingrained psychological tendencies, can sabotage even the most well-researched investment strategies. Loss aversion, for example, leads us to cling to losing investments far longer than we should, hindering our ability to adapt to changing market conditions. We feel the pain of a loss more acutely than the pleasure of a gain. Confirmation bias causes us to seek out information that confirms our existing beliefs, even when that information is inaccurate or misleading. We filter out dissenting opinions, creating an echo chamber that reinforces our biases. And then there's the herding mentality, the irresistible urge to follow the crowd, even when the crowd is heading off a cliff. So, how do we overcome these deeply ingrained biases? Develop strategies such as setting stop-loss orders to limit potential losses, diversifying your portfolio to reduce risk, and actively seeking out contrarian viewpoints to challenge your assumptions. Implement a pre-commitment device, a written investment plan that you pledge to follow, regardless of market fluctuations. Overcoming behavioral biases is an ongoing process, a journey of self-awareness and discipline. It requires a willingness to learn from your mistakes and to constantly question your own thinking. Like learning to play a musical instrument, it takes consistent practice to master the art of cycle-aware investing. Be mindful of your biases, challenge your assumptions, and cultivate a rational, disciplined approach to the market. Your portfolio and your peace of mind will thank you for it. What if we could transform economic cycles from a source of anxiety into a wellspring of opportunity? We've explored the rhythmic nature of markets, the illusion of permanence, the unseen lever of interest rates, the double-edged sword of debt, the waves of technological disruption, and the insidious influence of behavioral biases. These are the lessons that shape a long-term strategy, a strategy built not on fleeting trends, but on enduring principles. A cycle-aware investment approach demands a holistic perspective. It requires us to consider valuation multiples, debt levels, and technological trends, all within the context of the current economic climate. It demands that we anticipate the shifts, adjust our sails, and remain vigilant against the siren song of this time is different. But knowledge alone is not enough. We must also develop strategies for overcoming our behavioral biases, those ingrained psychological tendencies that can lead us astray. We must commit to our investment plans, regardless of market fluctuations, and resist the urge to panic sell during downturns or chase fleeting gains during booms. Warren Buffett, a master of long-term investing, wisely said, "Be fearful when others are greedy, and greedy when others are fearful." This contrarian mindset, this willingness to go against the crowd, is essential for capitalizing on the opportunities that economic cycles present. So, I ask you, will you embrace a cycle-aware approach? Will you commit to understanding the rhythms of the market, resisting your biases, and building a resilient portfolio? The path to sustainable wealth is not a sprint, it's a marathon. It requires patience, discipline, and a long-term perspective. Apply these lessons to your own investment strategies, and you'll be well on your way to building lasting prosperity, a legacy that can weather any storm. The market's breath may ebb and flow, but your financial foundation will endure.